Hello everybody, this is a short talk on spread trades. I want to A, make you aware of what they are, B, tell you about a spread trade that's looks pretty good right now. And it's a little different than ones I've done. Those of you who have been around for a while, you know I've spread traded gold before with gold stocks. This one's a little bit different. I'll get into that in a minute. But before we get there, let's talk about what a spread trade is. It's not a hedge. A hedge is where you're taking an opposite position to some longer term position that you want to keep in a portfolio. So let's just say I'm long some individual stocks. I want to trade around those by taking short positions against other baskets of goods. Maybe an ETF of a particular sector that's weak while I hold those longs because I think the market is going to go sideways to down. And so that's kind of a hedge. You're hedging a position you want to keep. You don't want to sell it. And you're taking something that's weaker and trading it short. A spread is a trade where you're taking some known relationship. And as that relationship deviates from some expected mean, you're trading those deviations. And so if I look at, for example, if I pull up a spread chart, I can take, two instruments that are correlated. And you can see the difference in that they spread differently, from one time to another. And as that spread contracts and expands, what you're trying to do is capture the difference between that expansion and contraction. And so if you keep drawing this out, you can see how it changes from, a big spread to a very narrow one. And what you're trying to do is capture those differences. Now, if you think about a spread trade, ideally, it can be either unidirectional or multi-directional. And ideally, you'd like the multi-directional. You'd like to be able to do it both ways. That's the ideal case. It can be one or the other, just like a range trade. It can be one direction or both. And so when we think about a spread trade, you have to think about your risk, your rewards, like always. The risk in any spread trade is that you've misjudged what the size of that variance is. So when we look back one more time here at this spread, if I think that this difference here can never be more than, let's just say, 5%. Well, if it can never be more than 5%, and I'm banking on that, what happens if it goes to 15? That's a problem. Right? So you have to get that relationship reasonably well defined so that you know what the limits or the theoretical limits are, because that's what you're trading. You're trading that difference. And so if you misjudge that, you can get yourself into issues, especially if you're arbitraging the difference in a very large way, right, in terms of a lot of money. So you got to get that right. And you got to be able to continue to average into that spread if it goes against you. So if you start a spread, and we go back to this, let me just pull it in real tight. If we start a spread here, and we're spreading, let's say that we're going long this instrument that's going to trade lower here, and we're going short the instrument there, and that spread gets to be a lot wider than we expect, or not wider than we expect, it starts to widen, we want to be able to continue to average into that with the knowledge that it's not going to go more than, if we're using that 5% number again, right here it's say 2% difference. Well, maybe I want to add some more at that difference because I know it can only get to 5 max, theoretically. So you want to know what that spread relationship is so that you know when you can average into it and continue to average into it. What's the reward? Well, the reward, of course, is that you can put a lot more money on the table in a spread. Why is that? Well, because you're playing both sides of it, right? I don't expect the deviation to be more than, say, 5% again. So in other words, rather than taking an individual position, either long or short, where the deviation can be, 10, 15, 20%, I'm not going to have as much money riding on that as I would a spread trade. In other words, I can put two times as much, 3 times as much money into a spread trade because I know that relationship theoretically is only X%. And so you can get more money on the table. Why is that important? Well, in a market like we're in now, where it's fairly elevated, has been for a long time, there's a lot of fundamental problems, and it's the bankers that are keeping it up, I know that the risk is higher, right? Just theoretically, it's higher than it has been for some sort of a larger decline. Right now, the structure of the market is that way where that could happen. And so if I'm going to put more money on the table instead of sitting on it, I want to put it on the table in a safer manner. A spread trade is a way to do that. What's the ideal spread trade? Well, the ideal spread trade is you have a well-defined relationship that's apparent and you know what it is. Ideally, you get paid to just sit there. Even if you don't make money on the spread, you'd like to have some sort of a dividend being paid to you for being in that spread. The instruments that you're spreading are not unidirectional with peaks and valleys of the spread variations, so they're reasonably well defined. You want to have something that you know what those peaks and valleys look like and what those extremes can be. If you can get all three of these, that's kind of the ideal spread trade. And this gold spread trade I'm going to talk about, it is well defined, it does pay a dividend, and this one is probably the one that's not as well defined in that the peaks and valleys, we don't know exactly what those peaks look like on the long side of the spread I'm fixing to talk about, and I'll talk about that more. So let's move into what this particular spread is. There's three instruments. There's always three instruments in a spread. Well, there's not always. You can have just two, but three is nice as well. And the ideal here is that you're going to have one instrument you're going to hang on to, and then you're going to have two instruments that you trade around that particular relationship. So in this particular case, you know, there's a spread trade that meets those characteristics that we just talked about that has to do with GLDI as the instrument that you hang on to, right? And then gold and DGZ that you trade around it. So gold itself, you know what that is, GLD, that's a long, well, it's not long, it mirrors gold physical. And so as gold physical goes up, it goes up. If it goes down, it goes down. DGZ is a one-to-one short of that physical. So it's a one-to-one relationship with gold inversely. GLDI is a rather new instrument. It's been out there a couple of years now. That's a cover call ETN of gold. And so they're reaping the premiums off of gold with these covered call strategies. And so you can get a dividend, and this dividend amounts to about 6% per year just by being in this. Now, one way to do it, of course, is just buy GLDI and just sit there. Well, that works well unless gold goes up a lot, because it will actually lose over time if gold goes up, and you'll lose that premium that you're getting on your dividend. So ideally, you hold this and you trade around it with these two. That's the spread. And so the covered call ETN is tightly coupled with physical gold. It pays about that much, which is about 6% per year. And if you can take the risk out of being long this, then you can get a 6% return. If you do well, you can get more than 6%. We'll talk about that here in a second. As far as the spread instrument, you always want to be long GLDI. So you're going to go long GLDI and you're not going to sell it. You're just going to sit in it. If anything, you're going to increase it over time. The spread part of this is either to buy the gold equivalent GLD when gold is trading cheaper than GLDI, or you sell gold, which is shorting it, using DGZ when it's the opposite. So more simply said, you always want to hold GDLI. You want to buy gold when it's near anchored support or it's pending a breakout. You want to buy DGZ, which is shorting the gold, near anchored resistance or pending a breakdown. Okay, now let's look at some charts so we can make sense of that. Here's gold now. What is it doing? Well, in the short term, moved higher, consolidated, and it's just starting to try and break out higher. So you're getting an attempt to break higher on this physical. If we look at, let me grab the other chart here, which is the weekly. Bear with me a second. There it is. On the weekly, you can see here, gold has made a low, right? Made that low on less volume, spikes up, retraces, and now trying to break out. So if I'm looking at just, the neoclassical thought here, the expectation is that gold is going to try to break out and trade higher. If that, in fact, is the case, now going back to this concept, you want to buy gold when it's either at anchored support, that's not the case, or it's pending a breakout, which is the case. So right now, we would want to be long GLDI, and we're going to just get long that and stay that, and we're going to buy GLD along with it. So that's the trade. Now if we look at that relationship, and let me pull that back up, if we look at that relationship, and actually let me do it this way, it might be easier to see. I've put a spreadsheet, and I'll attach the spreadsheet, a link to it in the notes that I send you. But in this spreadsheet, I've gone back since the inception of GLDI, the ETN, and I've looked at all of the larger moves directionally up or down, and I've kind of categorized them. Most of them are kind of jagged. They kind of move up, move down, that sort of thing. Some of them go straight up, straight down. Like here was a spike higher, here was a straight higher, and a straight lower. When it does the straight moves, you tend to get the largest variation. And to show you that, let me pull this over and slide this over for you. So I'm going to highlight the ones that went straight higher. That's these and straight lower, right? Not jagged. And I'm going to scroll over on this spreadsheet to show you the returns of those. So larger percentage moves, you can see the percentage moves are larger when that straight move occurs compared to those that don't. And so anytime you get a larger directional move without any kind of consolidation is when you have the potential to make more money, or if you're on the wrong side of the trade, to lose more money. So that's the first thing to recognize. So now I want to just kind of go over some of these and show you how they look. So let's just pick one. Let's pick this jagged higher, which is essentially what we see happening right now. And let's look at how that looks on the charts. And now remember, when gold's going higher, or you expect it to go higher, you want to be long GLD, right? And you want to be long GLDI. And so let me pull over a chart. So this is a spread relationship between these two instruments. 627, and I've picked tops and bottoms, so you're not going to get these kinds of returns because we're not going to be exactly at the top or the bottom. In other words, buy here, sell there. But what I want to show you is the relationship and how it alters, right? So it's a one-to-one relationship, right? Tight coupling. Here you get a little spurt up, a little difference, and then here you get a larger one. And so the percentage in this case moves up about 3%. Then it fades back in. Remember and let me go back here. Remember it was jagged higher, so it spikes up, spikes down. So it jaggedly moves, and it might be easier if I pull in a chart of gold itself. Let me grab that. And so here's a gold chart showing you the actual bars. So here's that move up, back down, move up again, right? So you spike up. Well, actually, this is a little bit more jagged, so it's kind of up and down. And then here it's fairly directional, and that's where the big move comes in the spread. So if I go back over here, right, this move from here to here is this move from there to there. And you can see as it spikes to the high here, gaps up, spikes to the high, that's when the spread widens. Gold is in the blue, GLDI is in the black. And so if you're long GLD, long GLDI, both are moving higher, but this one outruns it. And then again, at the very end here, when it goes directionally without any kind of pause, right, that's when you get the big spread take place. So the idea, of course, is you want to find when gold hits some sort of anchored support down in this area, put the spread on, and if it looks like it's working the direction you want, whenever you get an opportunity, right, potentially you add to that spread and make it larger. Or if you make it large enough to start with, you simply take some off, put some back on, that kind of thing as it goes up. Now, what's key is how long it takes to go up. Most of these moves tend to be about 2 months, or at least they have over the last couple of years, most of them. So, you kind of got a time duration you're looking at as part of the trade. You're also looking at the size of that spread. And so when we come back here and go back to the spreadsheet, right, when this thing spreads 4-5%, that's probably as much as you're going to get any given trade. Matter of fact, the mean, if you look at it, is lower, and the majority of those are in the 1% moves, right? And actually the green ones here are the long trades. So there's a 6.5, a 2, a 1 3/4, and a 5. On the short side, right, it varies more because that's gold tends to drop faster than it moves higher, and that's what all these green ones were. These are where you should have been long GLDI and long DGZ, which is the short of gold. Right now, it's up 0.8, and it's pending a breakout. And so if you're wanting to put the trade on right now, which I think is probably an okay place to start with a smaller position, kind of get our feet wet, we would be going long GLDI and going long GLD with the expectation that gold is going to break out and it's going to push higher, and that spread is going to widen. And it's going to widen potentially as much as 1 3/4 to 2%, which is another percent, or maybe you get the big run, big spike, and it jumps another 4 or 5% spread. You take it off, and when you take it off, you flip around, you go to the other side, and you put the spread on the other way. And so you keep working it back and forth. That's the idea. That's how this works. Hopefully that explains it. It's you have to, you might have to look at this 2 or 3 times to get it to sink in, but that's the idea behind the trade. Scaling is a big part of this. You don't want to just buy it all at once. You want to take a fairly large position. You want to be able to average into it maybe a couple times, just like we do anything else. It can spread, the difference between these two can spread 6.5 to 7.5%. But I want you to note that this 2-year period that we've been looking at gold and this spread has been available, right? That 2-year period, gold has been working slightly sideways to down. So the point of mentioning this is that the direction has been this way. Now what happens if it turns and it starts going this way on a longer term time frame? In that scenario, what we're going to be concerned with, if that happens, is that that spread on the short side, right, has a lot more risk. So in other words, anytime we move from long GLD to short GLD using the DGZ, that's probably when our risk is going to be greater if that relationship in terms of the direction of gold changes from short, which it has been, to long on a longer term time frame. Because you're going to see, that's where the real risk is. And that's what we have to guard against, and therefore, the mitigation strategy of that is, let's say that we put 20% of our money into this spread on longs. Well, we may only want to put 10% or 15% max on shorts. So we want to more favor the long because there's less risk in it then we do the shorts. Okay, that's the gold spread. That's how it lays out. That's what it is. Hopefully that gives you a good feel for what it is, and you'll be able to use that and come back to this and review it as needed as this spread unfolds and we trade it. All right, thanks a lot. If you have questions, let me know, and hopefully let's make some money on this. Take care.